Let's jump into another case study. Today we're looking at an NPL-JR that was paid. In other words, this is a non-performing loan in junior lien position that was paid as a discounted settlement with the borrower. So if we dig in a little further, we can see that this lien was secured by a single family residential property behind a senior current. That means that the first position loan was being paid by the borrower every single month, and there was full equity in the deal. So the value of that single family residential property was over $1 million at 1.25 approximately, with a $756,000 first lien balance. That leaves us with almost $500,000 of equity securing our junior position loan. And if we dig in even farther, we can see the exact metrics here showing a $492,268 equity figure protecting or securing our $334,716 unpaid principal balance. That leaves us with an equity coverage figure of 1.471. We're just taking the equity above the senior divided by our principal balance. And since that is greater than 1, as the investor in this deal, we have full equity coverage. But you also want to look at this from the borrower's perspective, and combined loan to value does that by taking the value that they owe for the first lien plus the balance of the second lien divided by the value of the home, the fair market value. And since this is less than 1 at 87.38%, from the borrower's perspective as well, they've got skin in the game here. They have value upside of both the first and the second liens that they owe. Now, let's look a little farther into the metrics here. And first is our cost basis. This is what we paid for the deal. And it was $164,900 to buy this loan. In other words, about 49.27% of the principal balance. Now, if we were to get a modification done, the original monthly payment of this deal was $2,343. And if we started collecting that regular monthly payment again, we'd be looking at an annual return of about 17%. Now, in this case, we did not pursue a modification agreement. It was on the cards as part of our negotiation, but we didn't move that direction. We actually got a discounted settlement on the deal. But if you want to do a quick and dirty calculation to see what your annual return on investment would be, you can take the monthly payment times 12 divided by the cost basis. And that's how we came up with that 17% figure, which is a really decent return, but we can do better than that. And in this case, we did with a settlement. So let's start here with the borrower's story. And this particular borrower was a little difficult to work with. Actually, we started receiving letters from this borrower and had no ability to communicate via email or phone. Everything was snail mail and took quite a while. Now, at the end of the day, that worked out for us, and that's one of the takeaways which I'll share with you at the end of this case study. Our potential internal rate of return on this deal, after a bunch of back and forth, the borrower originally offered $190,000 discounted settlement, but they owed over $300K, so we rejected that and tried to get $290,000. Then they pushed back with a potential modification, which also fell through. And finally, we were able to settle after their $275,000 offer on a final settlement of $280,000. So let's break that down for you, starting with the total amount collected minus the cost basis, what we paid, divided by the cost basis, or in other words, your return on investment, divided by the months it took to exit the deal over 12 to annualize the calculation. So if we take that $280,000 settlement minus the balance that we paid for the deal, $164,900, divided by $164,900, we get a 69.8% return on investment. But because this took a little bit over a year at 17 months, we do need to take 1.417 as the denominator on this calculation to bring that internal rate of return down to 49.25%. So you can see how this calculation works to calculate internal rate of return, where the faster you're able to monetize a deal, the higher your internal rate of return will be. Now, this is really contingent on redeploying that capital to continue to put your money to work. But when you look at it in a vacuum here, you can see that the faster a deal is done, the higher your internal rate of return. Now, a better way to calculate IRR is going to be with the XIRR formula in Excel, where you can have a bunch of different cash flows corresponding with the dates that those outflows and inflows of capital have been exchanged to get a very accurate internal rate of return over the course of an uneven payment string across many, many months. Now, in this case, since it was just a lump sum settlement and we're not calculating all of our expenses into the internal rate of return, this is a simple back of the envelope calculation that you can do to get a rough internal rate of return, or IRR, to make sure that you incorporate the time value of money into your calculations. So let's talk about some takeaways here, and then we're going to wrap this case study up, and I'm going to grab my notes so I make sure I have everything. First off, communicate with the borrower in their preferred format. In this case, it was via mail. That's not necessarily our preferred format. It takes a lot longer, and we'd much rather be emailing PDFs rather than printing and mailing documents through that snail mail process. So push for email and phone conversations when you can, but at the end of the day, you want to work with your borrower, and if mail is their preferred communication, you're going to keep going that route. Next is to determine the source of funds and the timing to release those proceeds. A $275,000 offer is just really nothing until the borrower proves that that has good funds that can be released in due time. Now, in this case, we were also able to continue our negotiations by counter offering those initially $190,000 offer with a modification proposal where we said, well, if you have $190,000 available, why don't you put that towards a down payment and start a modification for the remaining balance owed? Now, this option wasn't in the borrower's best interest. Part of their story was a medical issue where they were going to be admitted to a hospital very soon. So they wanted to make sure that this stressor was resolved and they were able to pay it off as a lump sum. So that was part of the negotiations, and you should definitely add that tool to your toolbox when a borrower makes a discounted settlement offer that doesn't fit your objectives as the investor. You could counter to apply that discounted settlement as a down payment towards a modification. And then finally, weigh the time and expense of a foreclosure against any discounted payoff in the short term. Often it's a win-win to agree to the DPO and then rather than fight for every dollar over that legal extended process through the foreclosure. So make sure that you calculate your potential internal rate of return in both scenarios so that you can see, based on the average foreclosure timelines in the state where that property is located, whether or not your internal rate of return is actually going to be better if you don't go through a foreclosure process that can take 2 years or more in states like New York and New Jersey where there's a judicial foreclosure process. So there's a lot you can learn from a case study like this, but you can do that with smaller deals as well. This was a large outlay of over $100,000 to purchase a balance of over $300,000. But all of these lessons can be learned with sub $10,000 balance loans that you can pick up for 5 figures or even less sometimes. So I'd highly encourage you to check out the Mortgage Note Mastermind, where we have no minimum trade sizes on deals just like this, as well as much smaller investments that you can start to get your feet wet in the note business. So until next time, we'll have another case study for you next month, and tune in next Wednesday for our quick tip video.